Unallocated cash is in a state of continuous decay. Every second currency sits idle in a standard account, it is actively losing purchasing power. To understand the velocity of this decay, look at the timeline of the US dollar. Since the early 20th century, the dollar has lost approximately 95% of its original purchasing power. A $100 reserve note issued shortly after the creation of the Federal Reserve would today purchase roughly $5 worth of equivalent goods. This is fiat inflation. It is not an increase in the inherent value of groceries or housing. It is the systemic dilution of the currency itself. As new money enters the supply, existing capital is mathematically penalized. Holding nominal currency is a guaranteed capital loss. Securing wealth requires moving that capital elsewhere. Investing is simply the necessary migration of capital away from fiat decay and into systems engineered to generate real yield. This matrix maps 8 distinct retail mechanisms available for a micro-capital principal of exactly $100. To evaluate them, we will run a mathematical stress test. The x-axis represents systemic liquidity. The y-axis represents expected value, the probability of generating a positive return. By mapping these variables, we can objectively isolate which systems algorithmically optimize low principal capital and which guarantee its destruction. The absolute baseline for capital allocation is the high-yield savings account. A high-yield account operates as a zero-variance liquidity pool. The principal is protected from nominal loss, and the capital can be instantly withdrawn. The trade-off for this zero-variance structure is a minimal real yield that often trails the actual rate of inflation. The mathematical utility of this system is purely defensive. By holding a highly liquid emergency buffer, a retail investor avoids relying on high-interest payday loans or credit cards when unexpected expenses occur. For centuries prior to modern banking, physical gold served as the primary hedge against fiat decay. Gold holds value because its supply cannot be algorithmically expanded or printed. However, the physical reality of retail gold accumulation presents an immediate structural barrier. Purchasing coins or small bullion requires paying a severe markup to dealers. For an investor deploying a micro-capital principal of $100, this immediate premium mathematically destroys a significant percentage of the initial value before the asset can even appreciate. Modern brokerage platforms solve this by offering gold exchange-traded funds. By buying digitized shares of vaulted gold, the micro-capital investor completely bypasses the dealer markup and gains near-zero overhead liquidity. High-yield accounts and digitized gold arrest the decay of capital. They do not possess the compounding architecture required to multiply it. To transform a $100 input into macro wealth, the capital requires fractionalization. The S&P 500 index fund is the primary vehicle for this transition. It allows retail capital to capture broad market beta, the overall growth of the economy, without the need to analyze individual corporate balance sheets. An index fund works by algorithmically aggregating and slicing the value of the 500 largest publicly traded companies. A single microcapital purchase is instantly distributed across the entire ecosystem. This chart maps the mathematical power of compound interest. A flat, uninvested baseline of $100 a month diverges from an index fund averaging a 7% annual return. Over a 30-year horizon, algorithmic compounding transforms those micro-capital inputs into a final total exceeding $123,000. This passive compounding architecture is precisely the system validated by Warren Buffett. In a decade-long million-dollar wager, Buffett proved that the raw market beta of a simple S&P 500 index fund mathematically outperforms portfolios carefully curated by highly compensated hedge fund managers. To maximize this system, the capital must be routed through tax-advantaged accounts, such as a Roth IRA in the United States or an ISA in the UK. By utilizing these legal shields, the returns compound entirely free of taxation. Without them, government tax liabilities create a systemic drag on the exponential curve, permanently lowering the final output. Fractionalization also extends to commercial real estate through real estate investment trusts, or REITs. These trusts pool retail capital to purchase income-producing properties, like office buildings and apartments. By legal mandate, a REIT is required to pass 90% of all taxable profits directly to its shareholders as dividends. Tier 2 systems algorithmically guarantee micro-capital access to macroeconomic growth drivers. They represent the mathematically optimal foundation for generating wealth. Moving up the expected value curve requires abandoning passive market beta in favor of high-variance active systems. Flipping niche items, like vintage electronics or rare collectibles, relies entirely on information arbitrage. The investor profits strictly by possessing asymmetric domain expertise within an inefficient secondary market, spotting a mispriced asset and selling it at true market value. This contrasts heavily with individual retail stock picking. Unlike a broad index, selecting a single equity introduces extreme variance to the portfolio, highly vulnerable to unpredictable market shocks and the random walk of daily price fluctuations. The active trading environment is highly chaotic. Outperforming the algorithmic efficiency of the market consistently over a long timeline requires a level of institutional analysis that a casual stock picker simply does not possess. Cryptocurrency represents an entirely different structural asset. It is an algorithmic, fixed supply network engineered entirely outside the traditional fiat banking system. While its fixed supply theoretically prevents fiat dilution, its catastrophic volatility risk is a known mathematical variable. Microcapital deployed during historical all-time highs has routinely suffered immediate, massive wipeouts of up to 80% within a single calendar year. Active systems in Tier 3 certainly offer the mathematical potential for exponential returns. However, surviving their catastrophic variance demands immense domain expertise that passive indexing does not. At the absolute bottom of the risk-adjusted curve sit systems of pure speculation, specifically the retail lottery. 57% of Americans participate in this system annually, routing massive amounts of microcapital away from yielding assets and directly into centralized state treasuries. To stress test this engine, investor Mark Tilbury deployed a $100 principal entirely into a sequence of scratch card lotteries. This calculation maps the outcome of that capital trial. The initial $100 principal rapidly depleted, returning exactly $50 at the end of the sequence. In statistical terms, this system carries a massive negative expecting value. The mathematics are strict. While a statistical outlier might occasionally capture a jackpot, the architecture of the game is mathematically engineered to permanently extract half of all capital fed into its ecosystem. Systems of pure speculation do not generate wealth. They are highly optimized engines of capital destruction, uniquely punishing those who hold microcapital. By zooming out, we can apply this analytical model directly to the initial problem of the decaying $100 principal. This completed dashboard permanently categorizes the 8 capital engines into 3 operational zones. The liquidity zone provides preservation. High-yield accounts and physical gold arrest inflation and prevent high-interest debt, but lack compounding power. The fractional yield zone is the proven engine of wealth. Broad market indexes and REITs leverage algorithmic compounding to turn microcapital into macroeconomic growth. The speculative zone contains the highest variance. These assets require massive domain expertise to survive, and in the case of the lottery, represent a mathematically guaranteed system of capital extraction. Turning $100 into wealth is a solved mathematical equation. It requires routing capital through tax-advantaged shields and capturing the passive beta of the broader market of avoiding systemic capital destruction, and simply matching the correct mathematical engine to the capital at hand.